And welcome. Welcome, everyone. It's Angelo Robles. I am live. For those of you watching live, it is a Sunday evening, 8 p.m. on a lovely yet cold February 1st. I am back from my travels in primarily Palm Beach and Miami. I had a wonderful time leading Family Office Day at Uncorrelated and met some incredible families. Thank you all for the invite and hopefully provided a level of education, a little bit of entertainment, and great getting to meet many of you. I have been asked this question before that led me somewhat impromptu after some of my research over decades and some of my thoughts and my allocations to discuss a little bit of how a $30 billion family, individual, quite the wealthy individual, and single family office, and it could apply to some degree to a multifamily office as well. Effectively, at that level of such incredible wealth, it's actually complicated. How do they invest? Even 1% is $300 million. So over the weekend, I put together some thoughts. I also did this exercise on 100 million, a billion, and really above, once you get above that kind of that 30 range takes you through about 60, 70 billion. I know I'm talking rarefied air. And I know many people in the Forbes 10 often worth well above 100 billion. A lot of it's tied up in their stock in companies that you would all know. So being relatively liquid, $30 billion plus for sure is rarefied air. So I am going to break down and the concepts of this. Now, I love to talk about counterparty risk, what could go wrong, geopolitics, banking and systemic risk, areas around estate and wealth transfer planning, and of course, taxes. But today is not that discussion. The world of great wealth can be very complex, involving all those things that I noted. But today, in my brief solo here on Sunday night, we are going to stick strictly to allocations. And by the way, I don't claim to have all the answers. I look for feedback from those live to participate and those after the fact to call me out on where you believe I might be wrong, or I can look at things from a different perspective. I always want to keep an open mind. Now, we do have to have a little bit of framework from what we're working with tonight. And again, I get it. It's very rarefied air. But trust me, here in the US and around the world, they're out there and more than some of you would actually think. So this would probably be most applicable to an individual. It could be their 40s, 50s, or 60s, likely family generations, 2 generations below them. So have a perspective on 100-year plan, as if we could do that in today's world, but let's give it a shot, at least from an allocation perspective. And by the way, not an important distinction here, not swinging for the fences, more so maintaining purchasing power, which could also be harder than what it seems year after year, decade after decade. So none of that, as anything, is any sort of guarantee. And for some of you that have followed my content, some of my recommendations and allocation are going to be against some things I've spoken about prior. I am not as big allocating as an LP in funds. I am an advocate for the most part in teaching the generations that there is somewhat of a level of risk that you want to mitigate, but perhaps some level of aggressive take in an interesting time, especially with AI that we're going through now. But this person, family office, and maybe rightfully so, is in a unique position. And maybe being hyper aggressive, looking to beat the markets, is not their goal. So I know this is going to sound or come across the wrong way to some of you. So there's lessons that we could all learn, no matter who we are. But yeah, there's a big difference between 30 to 70 million and 100 million or a billion to 2. Big differences sometimes. So without further ado, I think it is time that we get started. I'm kind of calling this Dynasty Capital, engineering century long wealth at 30 billion plus, kind of an investment architecture for families operating in truly rarefied air, a framework for $30 billion plus individuals, families, and family offices. And some of this goes back to wanting to share a discussion that truly exists in, as I said, very much rarefied air, investment allocations for families with the kind of resources and not tied up in one company or stock at 30 billion and beyond. And again, as I stated, and worth restating, not really a conversation where a lot of the nuances happen around structure, tax mitigation, estate transfer, teaching the family to be anti-fragile and not have them break apart with so much money. There's a time and place for that conversation. That time and place is not tonight. This is purely about allocation strategy and capital preservation at that level of wealth, really looking generation out and thinking in a 100-year plan. Now, as I stated, there are some parameters. Principals in their 40s, 50s, or 60s, 2 generations behind them, not looking to maximize growth, but preserving, as I noted, purchasing power over the generations. If you wanted more exponential growth, you need to have more concentrated bets that are often going to be at higher risk. And I use that word very loosely, bets, because to some degree, the stock market and investing is, well, welcome to the game of often things you can't control. And to some degree, it is like a bet. So you have a framework of what we're architecting here. Now, the framework doesn't account for that families might have specific sector expertise, technology, real estate, infrastructure, where more concentrated allocations may make perfect sense because they have an edge. But this is not that kind of family. A blueprint for more broad-based wealth preservation and purchasing power over time. And as noted, not really focusing on structure today, and legal and tax structures, onshore, offshore, private placement life insurance for certain hedge fund and other holdings are all incredible and a time for a different discussion and very synergistic to the conversation that we are having now. Now, I also actually used a little leverage here, really putting about 105%, because I felt like it, of capital to work. Also because this kind of family could. So 30 billion, 50 billion beyond, you could certainly borrow and go above 100% allocations. I share many of the same concerns that many of you follow my content around counterparty risk, banking, systemic governmental risk, etc., institutional vulnerabilities. At this level of wealth, there is no perfect solution. A modest portion, sure, should literally be cash in hand, gold in hand, gems in hand, and Bitcoin not institutionally held, but cold storage on your own. Of course, my God, even 1% of what I just described would still be $300 million effectively, with no counterparty risk in direct possession. So everything I'm about to share assumes that the fundamentals have been done, including what's the intent of the individual family and family office, their long-term goals, cash needs, risk tolerance, governance structures, and obviously having a rather comprehensive investment policy statement in place. We're kind of skipping over that. Now let's get to it. I'm going to surprise many of you who follow my content, but again, 30 billion and up is rarefied air. And this is the one where I think you could push back on my allocation. I'm going one third in cash and effectively cash equivalents and fixed income. At this great level of wealth, 1/3 into such things. Now, again, interest rates may be lowering and dynamics could change, but I'm just stating at the moment. And of course, you need to be dynamic in today's world. Now, I know what you're thinking. 10 billion sitting in cash equivalents or fixed income. It sounds insane. Well, not really. It's kind of power. Now, of course, I'm including laddered maturities, 30 to 90 days out, some 6 month, 1 year, 10 years. I probably would not go longer than that. A combination of US treasuries, other cash instruments, international sovereign debt, investment grade corporates, and for sure, at that level, a global infrastructure and multi currency exposures. Now, this number I'm giving may come down in the coming months, but for now, it can probably make a run at 5.5% annually. That generates like what, $500 million a year of cash flow. And you could write, here's an important part, write $100 million check easily tomorrow for an opportunity without disrupting your plan. In other words, cash at hand. You can weather a crisis like '08 without forced selling and really fund, obviously, although you never know, an entire generation's lifestyle without ever touching principal. But like I said, it's not just idle cash or dry powder, it's optionality and strategic patience. When everything else or everyone else is scrambling for liquidity during dislocations, oh, you are the buyer. When a once in a generation asset comes to the market, you can literally move effectively instantly. This allocation can allow you to execute on opportunities that families with even comparable wealth but insufficient liquidity simply couldn't pursue. Now, again, is a third probably on the high side? Could we shave a little bit off from there and put it somewhere else? That'll be for us to have the conversation about. And I get it. I know you're talking to the king of governmental risk, sovereign risk, banking risk, custodial risk. I get it. Sometimes you have no choice. And again, at 30 billion in my 1/3, you're diversifying across multiple currencies, jurisdictions, and obviously counterparties. Now, the alternative being fully invested when opportunity or crisis strikes, well, that could be, in my perspective, far riskier. I would put at this level 10% into a sports franchise, maybe multiple. I could say uncorrelated. I'm not sure if really anything is, but a scarcity of value. Here in the US, what, 32 NFL teams, 30 MLB and NBA teams? They rarely come to the market. There's a bidding war, and you having a billion or two, it's laughable. That's going to do nothing. Maybe in the NHL, but not in what I noted. Supply is capped for now. Demand keeps growing globally, and there's been asymmetric appreciation. The Seattle Seahawks were purchased, what, for $200 million in '97. They're into the Super Bowl, will likely go for $7-8 billion plus. The relatively lowly Charlotte Hornets in the NBA sold for $180 million in 2010 and worth about $3 billion now. What do you think the LA Dodgers, the Dallas Cowboys, especially if I include all real estate and everything? Third, you're diversifying revenue engines as an advantage, exploding media rights deals, international expansion into Asia and Europe, real estate development, technological integration, gambling partnerships, merchandise and streaming platforms. Should I go on? These aren't really single business models anymore. And fourth, you have a cultural permanence, gravitas, appeal, the owner's box. Yeah, presidents coming there, especially in certain teams. So economic cycles come and go, but sports franchises have endured. They're civic institutions, generational passion points, so to speak, and increasingly global entertainment brands that transcend borders and languages. And finally, legacy and access. Your grandchildren can own something that matters to millions of people. The relationships, the network, the cultural capital, these have a compounding value beyond the obvious and purely the balance sheet. It doesn't appear on it per se. At 30 billion, 10% means you could own potentially, you could probably, with your other assets, depending on, again, probably not the Cowboys. You're going to have to get into a higher rarefied air than probably 10 million that you're willing to totally invest. So there's lots of opportunities. And at that level, and especially if it's well above 30 billion, and to me, it's kind of a no-brainer. Now, precious metals get interesting. Is that a foundation that never breaks? Could I say 3% into gold? I mean, gold has been money for, I don't know, 5,000 years, has never been worthless. Central banks looking to buy more, has had a wicked run until the last couple of days. Boy, my timing's great. Empires have risen and fallen. Currencies have been created and destroyed, and yet gold remains. It's the only asset that's simultaneously nobody's liability and everybody has recognition of its value. When I'm architecting wealth to last a century, I want an allocation to the one thing that has lasted 50 centuries. Now, we don't have too much time to get in the direct ownership part of it. That gets interesting. What, 3% of 30 billion is 900 million in gold. You definitely want to have a part of that physical, stored all over the place, probably mostly non-banking, various jurisdictions. You're probably going to need to have some paper gold as well. That's just too big of an amount. And it's not only about returns, there's other factors. And broadly, remember, in uncertainty, that 100-year plan. Now, silver, I put it 1%, and we could debate maybe could that actually be 2. What most people miss, besides the intrinsic value of monetary metal, it is so critical for industry output, especially the AI revolution and solar infrastructure, electric vehicles, 5G networks. I probably went too late on that. Now, our problem again, is it physical ownership or on paper? Probably needs to be a combination. Every data center being built, every solar panel installed, every EV battery produced, they need silver, 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 physical silver. And while everyone's focused on tech stocks, they're missing the AI build out requires millions of ounces of an increasingly scarce metal. And this is how you capture technological transformation through a tangible, time-tested asset. Now, broadly, other commodities, probably 5%. A hard part at 30 billion is going to be the physical ownership, custodial and storage part, copper, platinum, palladium, and other strategic materials. Copper could be the new oil, the electrification of everything. Again, what did I say about silver? EVs, grid infrastructure, renewable energy, data centers require exponentially more copper. We're talking about a structural shortage. I mean, could last for decades. Platinum has industrial applications that cannot, as of yet, be easily substituted. Now, again, the challenge is like, God, you're too rich. At 30 billion, taking physical delivery of thousands of tons of copper, that's a logistical nightmare. Secure storage, not being taken from governments, bad actors, insurance, verifications. It's complex. I'm not saying it's not. It is. And again, we could get into commodity funds becoming a GP, taking in others, royalty streams, buying mines, strategic partnerships with producers become even more essential. You want exposure to assets that power civilization, today's world, and moving forward without becoming too much of a commodities logistics company. Digital assets. Again, many of you know I'm an advocate. I'm going to surprise you with my percentage here. I'm probably going, and we could argue, we could double this one. I'm going with just 1% in Bitcoin. It's 300 million. Now, we could debatably do a percentage, a multi-signature cold storage that you totally control. I wouldn't do 300 million that way. Institutional custodial platforms for a percentage. And you could even structure in vehicles that provide liquidity and lending opportunity. We could get creative on this. I mean, why Bitcoin at all? It should be pretty obvious, because it's if the next century looks anything like this century, what forward thinkers believe, It's increasing digitalization, potential currency instability, generational wealth transfer to digital native people. You want exposure to the truly first. We could get into, POW, proof of work. There's a whole bunch of things. Could we split that between Bitcoin and Ethereum? Although they serve different purposes, sure. And again, I could go on and on. Globally transferable, digital bearer asset, quote unquote. And no, it's not speculation. It's a generational hedge on monetary evolution. And if anything, I'm probably being too conservative with my allocations. Part of the issue is 30 billion plus. It's a lot of money to work with. Now, energy, civilization's lifeblood. At least 1%, I would say. Oil reserves, renewable energy infrastructure, next generation power systems. It's not optional for human civilization. We need it. And at 1%, you're positioned in the one sector that really touches everything. Economic growth, very simply, requires energy. AI, well, requires energy. Every future that we can imagine. And the energy sources will change over time, of course. But the energy needs are going to go way up. And one day we'll have fusion energy, but that one day is not today or tomorrow. This allocation ensures that you're not just consuming in the future, you're owning pieces of what powers it. Is 1% too low? Maybe. That's why I want you to go back and forth with me, but it still is 300 million. Art. Now, I would maybe increase this percentage for a family that has really deep knowledge and connections. I also put it at 1%. Hardcore museum quality art. A Rembrandt painted in 1642 is worth more than almost any investment made if you could do it in that era, 1642. Why? Because art becomes more scarce over time. Locked in museums, destroyed, held by collectors who never sell. Supply shrinks for reasons I noted, while global wealth has been growing. Beyond returns, art is the only asset class you could hang in your home, enjoy daily, share with guests, pass down stories that matter. It crosses border easier than most. We could get to gems and Bitcoin, I get it, but it's up there. Survives wars, currency collapses, and regime changes. Again, I can make the argument 1% for some might be too low. And the highest levels, we're talking about the Picassos, Basquiats, Warhols, Richters, etc. You're not just buying an object, as I noted. You're buying cultural immortality. Your family's collection becomes part of art history. I promise I'll focus more on some of the questions that are coming in, and I want you to be interactive, especially if you disagree and why. So talk about a legacy with art that you can see and you can touch. Now, 1% in miscellaneous, maybe tangibles, gems, rare color diamonds, historically significant pieces, collector grade automobiles, appreciate like art. I mean, there's others. I don't know if at that level, how much wines could you own, but hey, it sounds good to me. And no, they're not frivolous luxuries. They're portable, enjoyable stores of value that have held purchasing power generally over a long time. I just don't see putting in more than 1% at that level. And even that, I could argue, maybe that should actually be 1/3%. If you want to go by basis points, less than 1%. Now, how about the family compound and strategic, especially more personal real estate? Should that be 2%? But 2%, 600 million. 2% in family, like a gigantic family compound, strategic penthouses, Dubai, London, Zurich, etc. Oh, when I'm talking about maybe that farm and ranch land, that compound, we may be talking 10,000 plus acres, the great state of Wyoming, even a Montana, and there's others. And think even deeper, land, water rights, agricultural production, potential resources. It isn't just a retreat. It's a sovereign level of asset that produces food, again, holds water rights, provides general optionality if the world gets chaotic. Now, yeah, you can't move it. Yeah, governments could come and take it from you. It's imperfect, but it's something. And with 30 billion, you got to do something with that money. So layer in strategic urban positions. Like I said, a penthouse in Dubai's financial center, a residence, I didn't mention Singapore, in their most exclusive district. Property is noted in Zurich. These aren't just homes. They are, part of it's going to depend on your connections, residencies, and multiple passports, not for today's discussion, but they are jurisdictional optionality. Different tax systems, especially non-US or green card holder or citizens, legal frameworks, banking relationships, political stability profiles. At this level, real estate becomes like a geopolitical strategy kind of dressed as lifestyle. Okay, we're going to get into some level of what I would call institutional alternatives. I'm going to go 12% in the absolute elite of the private markets. But be selective. We're talking about LP positions in funds. Yes, Angelo's saying this. That don't really market, don't really need your money. They're used to monstrous institutional capital checks, which you are at my level I'm talking about, and turn away most billionaires at the highest level, Sequoia, the Blackstones, the Brookfield Asset Managements of the world, 20-year track records, unmatched deal flow, and you're coming in 12% collective in real estate, venture, and private equity. You got some real money to play with here. You are a real institution. I would probably have 3 to 5 different funds, each category that I noted: real estate, private equity, and venture capital. The best operators, the longest horizons, differentiated strategies for families. Yeah, for families with deep domain expertise, direct or co-investments. If you got it and have the team for it, go for it. Is that really what you want to do? Could I make the argument creating your own GP structure, forming a venture studio? I absolutely could. How much effort and work do you want to put in? For most, accessing institutional level quality managers at the money that we're talking about, you have great access. Compounding that capital through multiple cycles, I think in this scenario, that's a good path. I did carve out separately from that 5%. Some would say a lot in effectively infrastructure, logistics. Maybe this is the ultimate generational asset. Now it gets interesting. We're talking about Iowa State here at the level at 30 billion, and you got what, 1.5 billion or more to play with in this ownership and control, not just exposure, shipping assets, rail networks, trucking logistics, aviation, including owning planes and airstrips. Now you're getting into some of my sovereign strategies for the super rich. I'll try not to get too distracted because infrastructure assets, yeah, they could have 100+ year useful lives, generating inflation linked cash flows and become valuable as networks grow. Think deeper. A port today is more strategically valuable than it was 50 years ago. Global trade, well, for now, has exploded, but it's deeper. Again, at 30 billion, owning infrastructure gives you, it's the word I'm looking for. I'm going to go with visibility and influence over critical systems that affect everything else you own. And this is what I learned from hyper dynastic families that are part of the 100 wealthiest families in the world. You're not just investing in the economy, you're invested in actual pipes, rails, and routes that make the economy function, and that will transition to space as well. This is a century-long thinking manifested really as currently steel, concrete, and irreplaceable strategic positioning. Now, given that some of my business interests are still in, and when I owned Family Office Association, the great Greenwich, Connecticut, I got to give a little love to hedge funds, 2% into the elite of the elite. Now, yeah, like and by the way, I did consider black swan strategies, tail risk hedging, complex derivative overlays, but given the 10 billion, as I mentioned, in the 1/3 in cash and the like, quote unquote, liquid reserves, You have great diversification, cash flow, a multi-century horizon, and strategies that could be done with that to replicate some of the strategies that Universa and others do. And also, we didn't get to the stock portfolio yet. So that 2% that maybe goes into a 3 to 5, you could say you want to seed some other managers, but now your work's going to get harder. Managers who survived multiple cycles have a great team in place, a genuine edge, very few, and operate in markets or strategies that you, even at that level, can't or don't have the desire to build out to efficiently access elsewhere. Now, I could get into private placement life insurance, how it could be owned, but that's more of a tax and long-term strategic discussion beyond our conversation today. And a big fat 20% effectively in public equities, globally diversified, obviously liquid. Well, that partially depends, and professionally managed. Could you concentrate here like a younger Carl Icahn, taking controlling stakes, fight for boards, and create activist value? You could. Do you have the capability and skill set to do that? But the framework broadly assumes you're not running an activist fund. I'm assuming you're not. You're preserving and growing dynastic wealth across generations that will have different interests, capabilities, and risk acceptances. Public equities give you liquid exposure to effectively human innovation and economic growth without necessarily key person risk, the operational headaches, or the concentration risk of being all in on a few or quote unquote illiquid positions. Sure, diversify across geographies, sectors, and managers, use multiple custodians. I'm always concerned about counterparty risk, trust me. Think global, think liquid, think patient. Not the discussion to go deeper into the impact of AI with this. It's horizontal, it's going to touch everything. You know that already. You know my thoughts on that. But to some degree, a level of diversity per what we're talking about here, even away from that to a degree, is needed. Now, I would state, and I've done this in my sovereign work for families owning banks and insurance companies. I don't mean necessarily, unless you're on the board of like a public company, I mean in non-public. I think you should allocate about 3% to that. Some of it's about your own counterparty risk mitigation at the highest level. When you own and control parts of the banking and insurance system globally, you understand how money works, the world works. You have insights to what's going on, central banking and well beyond. How your wealth operates, again, you have that visibility and influence, and to some degree, reduce dependence or interdependence. We could debate that. You're not just a client, you're an owner who understands what's happening behind that secret curtain. And some say in the decisions that really affect your entire portfolio. The richest of the rich in Switzerland and beyond look to have powerful positions in banks and insurance companies. I'm telling you that. And I've been saying that for 6-7 years. Most of you don't listen. So I hinted earlier, I guess we're a little above 100% leverage and tactical capacity, maybe 5% leverage capacity through multiple secured lines of credit, asset-backed facility, strategic borrowing, leveraging banking relationships. It's not really just about juicing returns. It's about, to some degree, well, we could debate this as well, never being forced to sell, about being able to move faster on opportunities where you know you're buying into a distressed or turnaround or something you have operational talent and expertise in. Favorable institutional rates, this leverage costs you maybe 2 or 3%, but preserves optionality, is worth far more. Kind of my final thoughts, then I'll take a little deeper look at some of the questions, and please bring on your comments and questions. I could argue, given my background and experiences, but I'm going back again to the 30 billion. Was I a little light with crypto and digital assets? Possibly. The framework for sure is adaptive, not static. As AI reshapes every industry, as digital currencies evolve and new asset classes emerge, that 10 billion in the cash position and leverage capacity lets you pivot strategically. That's why I keep on coming back to that. This is a robust, in my opinion, starting framework built on my decades of global experience in knowing some Forbes 20 and incredible families, hundreds of meetings with family offices over my decades, managing a scale like what we're talking about, and lessons learned, good and bad, that humble everyone, at least in the short term and eventually. Now, sure, my allocations, I believe, whether they're 100% in my perfect total or a little leverage at really 105, you're going to have access to favorable terms at that level. Look at your connections in banks are going to be incredible, besides your ownership of some. So going modestly above 100% through strategic leverage is not only possible, but often advantageous. Debatably, again, I know we could go back and forth for liquidity management and opportunistic deployment, redeployment. So I'd like to tell many of you to join this conversation. For family offices and institutional allocators, this type of systems level thinking, understanding geopolitics, macro shifts, and positioning for effectively a changing world order, navigating counterparty risk, AI, architecting multi-generational wealth preservation. This is exactly what I do and have been doing for decades in my private intelligence and strategy community, SFO Continuity. If you're looking to connect with me, with incredible peers, and the leading thought leaders upon these subjects, thinking decades and centuries ahead. Come on, we're going deep into space tech, who are positioning portfolios for the world being built now and how the world will look, especially over the next 10 years. Join. Go to angelorobles.com and be a part of this special community. It is the premier network for an intimate group of currently under 100 incredible families and family offices, the most sophisticated allocators sharing their insights, their failures, their challenges, their successes, so we all collectively learn, and continuing, honestly, a conversation where it belongs among peers who are operating at the highest level. Now, again, some of this is meant for entertainment, for engaging purposes, my experiences, but you all have different risk tolerances, cash needs. Not everyone is 30 billion and above. Honestly, some of the things or percentages I noted, if you're only 1, 2, or 3 billion, I would do things differently, and depending on, again, what your goals are, which is why over the next couple of months, I'll do more variations of this at 5 or 6 other benchmarks. Past performance is no guarantee of future results. And when you invest, even in something that appears secure, US government treasuries, you just don't know. There's a lot of chaos going on now, and things could change very, very rapidly. When you invest, sadly, you can lose everything. So I want to reiterate that the world is changing rapidly. This is a specific view for a very targeted, specific audience or example at any given time. And the geopolitical landscape, macro, the debt here in the US, AI, you need to be adaptive and tactical. You have to be in today's world. Sure, again, we could debate some of my percentages, even broadly some of the allocations. I didn't even really bring up AI that much. I think it's complicated at this level. Now, if I had 2 or 3 billion or less, that would take more of an aggressive tactical approach where I would have weaved in some stocks and others that many of you are not as familiar with, and some private deal flow that could have been a better option. But again, we're being very, very targeted. And as always, be very alert to counterparty risk and other subject for my members and family offices that we will be doing more of. So again, it's some level of, we're all taking guesses here. Having 30 billion, I can't really say that's a burden, but it does come with complexities. Do you think it's easy for children or grandchildren growing up in that kind of environment? You don't think that creates a lot of grave challenges? The pressures from multiple different ways, including wanting to do good and impact and philanthropy, which is why governance and helping to frame and teach anti-fragility in the rising generations is really anchor to a 100-year plan, more so than allocations and the investments that you choose. But I know many of you enjoy the investment conversations, so I do want to keep them coming on. We have a very, very good turnout tonight. I knew this subject of investing like effectively 30 to 70 billion if you're that individual family or family office. And I get it, it's rarefied air, but trust me, they're out there. And yes, I'm often asked, are there families, maybe collectively, not individuals, worth more than even the wealthiest person on the Forbes 400? Let's call it Elon, what, at 4 or 500 billion? And with what he's doing in space tech and all that, we absolutely will have official trillionaires sooner rather than later. But are there trillionaire families on this earth right now? Yes. My travels to Europe, my travels to the Middle East, I have no doubt about that. This is my life. This is what I've been studying for decades, why I travel the world, why I've been so lucky and fortunate to meet so many incredible people, families, and investors, and try to learn when I keep quiet and I could actually ask a good question and listen. Sometimes that does happen. And being someone who's pretty good at connecting the dots and being somewhat future forward thinking. So there are some questions. I really encourage you, come on, bring it on. I'll stay on, well, as long as needed, but bring on the questions, bring on your comments, what you would do differently from the perspective that I noted. I want the other perspective. Trust me, I don't feel I have all the answers. Maybe my 1/3 in cash equivalents and fixed was too much. I could have put a notch, 2 or 3% more into silver, commodities broadly, a little bit more into crypto. But again, realize the money that we're talking about. 1% of 30 billion is 300 million. That's a lot of money. How much am I going to put into silver, diamonds, gems, collectible cars, Bitcoin on a stick that I'm keeping somewhere? I mean, this is rarefied air. It's very different than for someone at the 100 million, billion to what's the lowest level to be on the Forbes global 400, maybe like about 7 billion. I should do one on that number too. I indirectly did about 2 years ago, but hey, the world has changed and AI was a part of that. So let's see, should this $30 billion family love privacy coins as part of their crypto allocation? Now that's a deeper discussion. One of the questions that came in that we have time to cover today. I might have hinted at it a little bit with proof of work with Bitcoin. And if you're not really in crypto, I'm talking a language you probably don't quite get. So are you implying 5 or 10 million into something like Zcash or Monero? Sure. We will have some guests on in the coming months where we could talk a little bit about that and maybe some of the challenges with Bitcoin, which is why I kept it simple, but we could arguably have more diversity. But at 30 billion and even talking blocks of 1%, we could of course do much less, but you also want to move the needle. Are you just doing it for fun or doing it because you're looking for the opportunity, the autocorrelation, or to hedge certain risk? So the third liquid is Genius and percent. I didn't quite get that, but it popped into my head. Genius Act that was passed the past summer in 2025, what that's doing to the pumping the US dollar, stable coins. How I could broadly take that is that's really good for our fiat currency backed by nothing. The US is the currency where most of the world settles, and the US government will definitely do practically anything to protect that. Stable coins were literally genius and being called the Genius Act, and this will be good for America, broadly the dollar. So do you invest in stablecoin public companies like Circle? Do you have more activity in crypto that is directly related? What could you do around lending? That's a complexity of an answer. I gave you a little part of it now. I didn't want this to get hyper complicated. And I don't know if poof, I got $30 billion liquid. I don't know if I want my life to be that hyper complicated from this perspective. In philanthropy and other purposes, yes. But we're diving a little deep now. So is this 10% based on, it's a little vague. Primal Key asked a couple of questions, and my friend, feel free to ask more. And again, I'm going to keep it going a little bit for the audience that has questions. Generally, I see some comments, 1/3 in cash and fixed income is too much. Angelo, you were too conservative in commodities. You were, what are you, from Greenwich? Someone said too conservative, or London, in hedge funds. Bump that up to 5%. I mean, find me a great manager, maybe at that level. Those are things I could be considerate to. Some of you felt and more comments really than questions, that I, as opposed to 12% broadly as an LP. Now, I could argue, should you create or be an investor in the GP? We could all make those arguments. Now you have arguably additional work and more liabilities. So there's drawbacks as well. But is 12% too low at the level of wealth we're talking about in real estate, private equity, and VC combined? Again, you can make that point. Many of you would probably take it away from all the 1/3 that I have in cash, but don't discount my 1/3 in cash. You got a lot of dry powder. You could do a lot of tactical opportunities with a world in chaos, especially if you're somewhat good in real estate and private companies and have somewhat of a network. I mean, we could even dive deeper into farmland, water rights broadly, thinking more global. We could get into, if you're a US citizen, yeah, of course, I want you to have diversity of residency, passports, banking and other relationships, gold and other assets stored offshore. At the end of the day, though, look at all the tremendous advantages, even with the wicked chaos and challenges we have here in the US. I mean, are we still really the one-eyed giant in the land of the blind? That's no disrespect to countries like Switzerland and Singapore. At the level of wealth I'm talking about, absolutely. And even parts of the Middle East, again, buy that penthouse, have banking relationships. I got it. I just look at a variety of reasons, even with our social unrest and challenges we have, why in some ways the US is very, very well positioned. So, and I admit I'm a lover of Wyoming, but certainly Texas, Florida, Nevada. Montana does have state tax, but has other advantages. We've done deep dives broadly on the subject, including weeks ago with Dave Lesparence, not quite as much on each specific state in the US. So those are interesting, intertwined subjects, onshore and offshore strategies, foundations, how are they investing? Again, I could go on and on with this for 4, 5, 6 hours. I wanted to keep it contrite at within 1 hour and provide from my experiences and my perspective and insight that I just don't really hear anyone else in the family office world talk about. So I know there's people that know more than me on family governance, on areas around certain areas around lender and structure. And I love them. They're incredible. And I want to learn more too. And they're very valuable, maybe more valuable than what I'm talking about. But I just don't hear the conversations that are open and honest around geopolitics, deeper macroeconomics, challenges, but advantages we have here in the US as well. Also, a more global perspective, which I think is important, and around areas like this, really interacting, having a cigar with someone worth decabillions and learning from them. And my work in AI, I think, makes the areas that I do have a focus on, and I should focus on what I know really well, and more importantly, have connect level of insight specifically, although I'm happy to share some of it more broad, like I'm doing tonight, but my members get the special access. And this subject and the other levels of wealth will absolutely be covered for my members at my annual 4-day marquee event in Palm Beach, March 16th through 19th. Some of it is up on angelorobles.com, my website. For now, I'm keeping the agenda more private and hidden. My members will get that fully in the next week. And I'd like to hope there's value. Even the things that I'm sharing now, like, can I still save you 10 years from how it's executed, how you do it? How do you buy that bank in Switzerland? How do you set up that offshore insurer? How do you structure your lender structure for a family office, but do it really properly? Where do you store offshore silver and gold? Where are you buying supply chain infrastructure that you're building or buying in rails and ports? And why? There's some of it is science, sure, straightforward. A lot of it is art and having the connections to other families and the really deep thought leaders. In Miami, we had, I think, the number one family principal of a family talking about some of the issues on infrastructure from a European and US perspective and what they're doing in maritime and other areas around shipping. But much more than that, as again, the infrastructure plays, supply chain management, that I think in a chaotic world is going to be more important than ever before. So, in my promise to keep this under an hour, which is not always easy for me, I still got 8 minutes to play with. But I think if there's not anything further from the audience, and again, even after the fact, as you hear this non-live, I want you to interact with it. I want you to say that I'm wrong. I want you to give me what the allocations you think they could be. I want to learn from you. And I appreciate all of you, especially those that are interactive. For my members, of course, always have love. You could reach out to me one-on-one anytime, and make sure that you're a part of my Palm Beach Forum, which is by far my marquee in-person event, March 16th through 19th in beautiful Palm Beach. I will wrap it up within 30 more seconds if there's not any further comments, which I read off about 7 or 8 in questions from 1 or 2. I hope you're enjoying the beginning of February. I know it's cold in much here of the U.S., the country, but hey, the Four Seasons could have its charms, that's for sure. It was colder in Miami my last couple of nights there than I felt in a long time, but I shouldn't moan about 48 degrees when I'm well below that where I am. If you're all okay with it, I think I've earned my cigar for the evening. It's almost 9 o'clock. No football to watch until the Super Bowl next week. No travels until probably my 10 plus days I will be spending in South Florida, mainly Palm Beach during the time frame that I noted in March. So on that note, other projects this week for sure, at least one more solo. I have an incredible guest coming on 4 o'clock Eastern on Wednesday. Some of these subjects, he's wickedly high IQ, engineer by training, very thoughtful, and really a first principles thinking expert, and someone who has a lot of thought on political, geopolitics, a lot of different subjects. So I look to go at it with him. I think that's going to be a lot of fun. And all of you, I appreciate all of your time. I hope you're having a wonderful Sunday. Keep in touch with me during the week. I hope you have a great week. I'm back from those travels, so you'll hopefully see me on average 2 or 3 times a week. Until we get to March, then we may have a block or two, a week or two, where I'm just hyper-focused on my marquee program, my Palm Beach Forum. So again, go to angelorobles.com and learn more. I appreciate all of you and have a wonderful night. Thank you.